One of the best ways to handle a market crash is to stay focused on the long term and be open to making changes and corrections if needed in the short term. And with the market in a jittery mood thanks to the ongoing inflation, the interest rate hike mania and geopolitical instability, nobody can blame the investors who are wringing their hands anxiously in anticipation of a potential market crash. And thankfully, the chances of a crash happening are too difficult to determine with any certainty, so it does not make much sense to worry about it at any particular time. And that probably might not be very assuring, but the one silver lining in all of this is we have no control over when the stock market can crash or when the stock market crash can happen. What we can only do is react in ways when a stock market crash can happen. So we can prepare in the ways we are going to react if and when the stock market happens and how it happens. But what will be reassuring is if you have a plan for what to do and what not to do in the event of a crash. So for now, let's work on 3 things you definitely shouldn't do if there is chaos in the stock market. The most important thing not to do is to sell your stocks in a panic. The first and the most important thing you should never do if the market crashes is to sell all of your stocks to try to avoid experiencing any further losses. Now, if suddenly your portfolio is down 15-20% and people start to get anxious and they just want to get out of this mess, and one of the worst things you could do is to sell all your stocks in a panic. The problem with panic selling is that it feels like it's the right move. And after all, if you can cut your losses fast enough, the market's downward move to the tune of 30% might only lead to losses of 10% for you. Selling eases the sense of anxiety you have about your lack of control over the situation and your fear of losing money. And if you hear from your friends or relatives about how much they got whacked by holding on to their shares, you might even give yourself a pat on the back, but you'll probably end up missing out on the rebound afterwards. And in most cases till now, that means that you'll make less money than if you would have simply stayed the course. I know that even if history is the guide is to hold on to the stocks when they're going down because eventually they'll go up, there's no guarantee that every stock that goes down will go up with time. So that doesn't mean that you should just hold on to it, but I think it's wise to play it smart. And even if you get out of your position, I think it's very important to just watch the stock, and if it goes down much further, maybe it could become a massive opportunity. Like if you still feel like the company is worth it irrespective of the stock price, I think buying that stock when it's down 30% could be the best move you could make in a stock market crash. Now, this is one of the most common way people profit from a stock market crash. When you do begin your journey of investing, everyone sets and has a fundamental rules which they all promise that we will follow. Not everyone follows. The people who follow to become the best investors, but even the rules and the fundamentals you set have to change from time to time because the atmosphere in the financial market is shifting regularly, and you don't have to dramatically change your investing strategy without good reason in a stock market crash. In keeping with the above, the second thing that you should not do if a stock market crashes is to switch up your entire game plan for investing without nodding onto it for a good while. It is a fact of life that crashes are often precipitated by economic or global events, and in reality, most of the stock market crash have nothing to do with the stocks or the company. And nonetheless, if you have a properly diversified portfolio, all of your stocks genuinely vulnerable to further declines all at once. And that means any changes to your approach should be at the margin even after the crash. For example, let's say before the pandemic you held AMC Entertainment, which is down 10% for exposure to the entertainment industry because everyone were in lockdown and there were no times for shooting. And the market's collapse in March was caused by fears of the pandemic, and AMC's share price was hit plenty hard. And as an intelligent and far-sighted investor, you held on to the shares at the time, but doing your quarterly assessment of your positions, you decide that movie theaters are not probably going to making a strong comeback for as long as the pandemic is still going on, and you opt to sell your shares. And it's so far so good. It's important to make adjustments to your strategies when new information makes your original investment irrelevant. And the final thing which the investor should never do if the market crashes is to stay on the sidelines and wait for things to settle down. Instead, they should take action to buy while shares are cheaper than normal, and that's especially true if you plan to dollar cost average to build up your positions. And for those who have a lot of capital saved up, sharp and panic-driven downturns are usually opportunities to shore up your holdings with deeply discounted shares once again, assuming that your original investing thesis about why the company is worth buying is still valid. But if you do decide to sit on the sidelines during a crash or correction, you won't be actively harming your portfolio's value, but you'll likely be missing out on growth. And for people like me and you, missing out on growth usually means it mentally feels that your portfolio is down, it's not where it should be. It's frightening to buy more shares of a stock when it's down and when it seems like the sky is falling, but famous investors like Warren Buffett, they do it. They bet high when everyone bet lows, and most of the time it has paid off. And for companies that pay a dividend, buying rather than idling means that you'll be securing shares with higher dividend yield that you could normally get. So you'll get paid for your smart decision to take a hard bargain for years down the line. Let's say a company is worth buying at $500 a share. And it has been there, and it has been worth buying for $500 a share for the past 2 to 3 years, and suddenly if the stock goes down to $250, it is actually worth more than buying. And I think that's what it means to not stay on the sidelines and to cash in.